welcome back to Metro Morning Live. Time now is 10 minutes past the hour. As we do each and every Tuesday, we talk finances with Jim Griffith of Griffith Financial, and our segment we call You and Your Money. Good morning, Jim.
Good morning, Rob. How
You
you
all right
doing?
this morning?
I'm doing great. How are you?
You saw Dennis Rodman a moment ago?
I did.
Okay.
I did. Dennis is so passionate.
Yeah, he is.
Really?
All right. He was just like he was when he played basketball.
Was it like that?
Yeah.
Okay. All right.
Nuts. All right, Jim, this morning we're going to talk about successful money management. Now, when it comes to that, what's the key to successful money management?
Yeah, the key to successful money management is to realize that you need to have a sound strategy with the money that you get. The things to keep in mind is, number one, that time is very important. The other one is that you need to have an understanding of what your financial profile is. Also, you want to make sure you understand the importance of maintaining a good credit score and exactly what that credit score means. Also, you want to keep in mind that there's a certain amount of cash that you need to keep on hand at all times, and also understand the impact of taxes and inflation on your money, and also when to rebalance your investment portfolio.
Okay. Now, how does time affect money management?
Yeah, time is critical because the earlier you start managing your cash and investing it, the longer it has to work in the market so you can accomplish the goals that you want to reach. The other thing is that it allows the power of compound interest to work, which means that you have the money you put in, it earns interest, and then you earn interest on top of that. So what that does is that allows your money to grow a lot faster over a period of time. And it also gives you ability to save more as you make more. So when you get down the road to retirement, you actually have had more time to accomplish that goal. Okay.
And when it comes to financial profile, how important is it for people to know about that?
Yeah, your financial profile is very important. Because when you put money into an investment, you need to understand whether you're conservative, whether you're moderate, or whether you're an aggressive investor. If you're conservative, you're probably going to lean more toward things like CDs, savings accounts, which is kind of a mistake if you're looking for a certain amount of money when you get ready to retire. If you're moderate, you'll probably have like a 50-50 split, 50% maybe in cash or bonds. The other 50% will be in stocks and things like that that'll grow your money a lot faster.
And one thing that people are concerned about is their credit score. Why is that so important?
Yeah, your credit score is extremely important because when people think about credit score, the only thing they think about is just the financial side of it. Credit scores have become more than that. Employers look at your credit score as a representation of your character. So when they get ready to make a hiring decision, they're going to wonder if you have a bunch of charge-offs, if you're late 30 days or 60 days on making your payments. It doesn't reflect very well because if you're trying to get a job that has a certain security, you need a certain security clearance, well, that could compromise the company because you're at work worrying about paying your bills, and it also creates a situation where you might be subject to accept money when you shouldn't and in return for disclosing information for the company. It also affects your ability to rent an apartment. When you go and fill out that application to rent an apartment, they look at that, and if they see where you're constantly late making payments, you probably won't get that apartment.
Wow.
Insurance companies look at your credit score. If you have a 500 and someone else has a 750, well, the person that has a 750 credit score, the cost for their insurance premiums will be lower. So you want to definitely stay on top of that credit score. And also, when you go to just simply apply for loans and things of that nature, it's very important because if you take a $400,000 mortgage and a person has a 500 credit score versus a person with a 700 credit score, the person with the 500 credit score, let's say they get an interest rate of 5%. Well, the person with the 700 would get an interest rate of 4%. Now, if you take that and calculate the mortgage payments on it, the person with the better credit score is going to get a lower mortgage payment. That might be $1,966. The person with a bad credit score, their mortgage rate might be somewhere in the neighborhood of $2,354. That's a difference of $338 a month. If you take that and spread that out over the course of 30 years, the cost of that house for the person with the poor credit score is going to be $140,000 more. So it's very important to keep that credit score in check.
My goodness. Well, how do you decide on how much cash you need to hold on to?
Yeah, that depends on what your situation is. If you have a lot of obligations, needless to say, you're going to need to keep more cash on hand. If you have less obligations, that's great because you can keep a smaller percentage of cash on hand and take the balance of that cash and invest it appropriately so that you can plan for a good retirement. People with a high net worth, believe it or not, actually keep less cash on hand and they put more cash into investments to generate income or to get growth. The main thing is that it depends on a person's goal. If a person's, let's say for example, if they're in the business of flipping houses, they might want to keep a lot more cash on hand to take advantage of opportunities as they come up. The rule of thumb is you want to keep somewhere between 6 to 12 months of cash on hand as an emergency fund. But the other thing to keep in mind is that once you start getting beyond that, always remember that cash is the worst possible investment that you can have.
Wow. Well, why are taxes and inflation so important?
Yeah, taxes and inflation are really extremely important. Let's take, for example, you have a $10,000 in cash. You put that in the bank at 1% in a CD. At the end of the year, you're going to have $10,100. If you're in a 25% tax bracket, once you pay the taxes on that, that's going to reduce that money from $10,100 down to $10,075. Now we come back and we have hit that with 3% inflation. Now you've got about $9,775. So that certificate of deposit has turned into a certificate of depreciation. Okay.
Okay. Now, Jim, when should you rebalance your portfolio?
Yeah, that's also based on the individual. If you're in a lot of bonds and interest rates start going up and you feel that you know that you're going to need cash, you might want to rebalance that and pull some of that money out of the bonds and put it into a cash position because as interest rates go up, the actual value of bonds will drop. And there's an inverse relationship there. The other thing to keep in mind is that we've been in a bull market for about 10 years now, so people are starting to get market jitters. So if you're getting a little afraid of the market pulling back, which we think is going to happen, you definitely want to rebalance that portfolio, take some of that money out of stocks, put it in the bonds, or set it down in cash and let it sit there.
Well, I don't have to worry about that, Jim. I don't have to worry about no stocks and bonds.
Oh, you got stocks and bonds, right? You got some stocks.
Well, Jim, what's the worst thing you can do when it comes to money management?
Yeah, the worst thing you can do is actually procrastinate. And I'll tell you what, let's take a look at this quick clip, and it'll show you what it means.
When investing for retirement and other long-term goals, you want to put time on your side. The sooner you begin investing, the longer your money can work for you. But it's easy to procrastinate. Let's take a look at what procrastination can cost you. Sally and Bob each decide to invest $250,000 into a retirement account. When Sally turns 50, she starts contributing $25,000 a year to an account that earns a hypothetical 6%. After 10 years, she stops making annual payments. Bob, on the other hand, puts off his investing program. Finally, at age 60, he begins setting aside $25,000 a year into an account that earns a hypothetical 6%. Though both have contributed equal amounts, Sally has the magic of compound interest working for her. When they both reach age 70, Sally's account balance is nearly twice the size of Bob's. Procrastination can be costly, and as Bob learned, when you get a late start, it can be difficult to make up for lost time. Call today, and let's get started now.
Always great information, Jim. Anything else you'd like to add this morning?
No, that's about it. Basically, if anyone has a need for help, we're here to help. We're not trying to sell anything. We are in the business of helping people solve problems, accomplish their goals, protect their families, and have a comfortable retirement.
Well, where can they find you, Jim?
Real simple. Just go to griffithfinancialservices.com. That's our website. You'll see the little tab there that says Contact Us. Click on that, send us an email, and we'll get right back in contact with you. Also, you can get us by calling 800-361-6542.
All right. Great job as always, Jim.
Well, thank you, Rob.
Jim, there's a big battle of the bands coming up later this month.
I plan to be there.
I know you will.
I plan to be there.
Stay with us. We'll be talking about that and more after the break.